Hello everyone, I am Michael Ruger. I am the managing partner of Greenbush Financial Group. Today we're going to be reviewing the SAVE program, which is the newest student loan repayment option that the Biden administration just made available to borrowers starting in 2023. And what's unique about this program is not only is it income-based payments, which means it varies based on your annual income amount each year, but there is also a forgiveness aspect to it. So once you've made payments for a specific number of years, any remaining balance is completely forgiven. You will most likely be hearing a lot about this SAVE program in coming months because when you compare the SAVE program to the other income-based repayment programs that are out there for student loans, there's a lot of things that make this new plan superior. So today we're going to be covering how the new SAVE plan works, how does the SAVE program compare to other student loan repayment options, how are the monthly payments calculated under the SAVE program, what type of loans qualify for this SAVE plan, how do you actually apply for the new SAVE plan, how does loan forgiveness work under this new plan, who should avoid completely enrolling in the SAVE plan, and we're also going to review the new Fresh Start plan for any borrowers that have in the past defaulted on student loans or had delinquent payments. First, let's cover what the SAVE plan is. So the SAVE plan is the newest IDR, which stands for Income-Driven Repayment Plan for student loans. When they go to calculate your monthly payment, it's based on two things: your annual income for the year and your household size. And then once you're in the program, after a set number of years, then any remaining balance is forgiven. The SAVE plan is actually replacing the Repay plan, which is another income-driven repayment plan that's currently available to borrowers. So any borrowers that are currently in the Repay plan will automatically be transitioned over to the new SAVE plan. Now let's cover what type of loans are eligible for this new SAVE program. So only federal student loans are eligible to be entered into this new plan. If you have private student loans, Parent Plus loans, those are not eligible for this new program. The good news is whether it's undergraduate or graduate student federal loans, those are both eligible for the SAVE program. However, depending on what type of loans you have, whether they're undergraduate or graduate, there's different repayment terms and there's different forgiveness criteria for each of those two flavors of federal student loans. Let's talk about how the monthly payments are calculated under the new SAVE program. So for many of the other income-driven repayment plans that currently exist, most of them require the borrower to pay between 10 to 20% of their discretionary income towards their student loan payments each year. But under the new SAVE program for undergraduate loans, it's only going to require the borrower to commit 5% of their discretionary household income. We, of course, have to be able to define what do they consider household discretionary income for purposes of that 5%. So when they talk about household, if you're married and you file a joint tax return, when you complete this SAVE application, you're going to have to report the income for both you and your spouse. However, there's a carve-out in this new plan that says if a married couple files their tax return married filing separately instead of married filing joint, then only the spouse that's applying for the SAVE program has to report just their income instead of their income and their spouses. So while at first that might seem like, oh, this is a no-brainer, we should do married filing separately, less income lowers student loan payments, you have to remember there's tax ramifications for going the married filing separately route. Usually the tax rates are a lot less favorable when you go from married filing joint to married filing separately. So you have to really do the analysis and consult with your tax professional to say, okay, well, we might win on the student loan payment side. How much are we losing on the tax side by filing our taxes married filing separately? If you're a single filer, it's straightforward and easy. It's just your income. That's the household portion of the definition, but what do they consider discretionary income? So usually discretionary income is defined as whatever money you have left over after you've been paid and pay all your bills like rent, utilities, car payments, all that good stuff. But since everyone has different expenses, that's not necessarily how they define it for purposes of this new SAVE plan. So purpose of the SAVE plan, your discretionary income is your adjusted gross income, your AGI, minus 225% of the federal poverty level income. The federal poverty level varies depending on the size of your household. And for 2023, the levels are this. So for individuals, it's $14,580. For families of two, it's $19,720. For families of three, $24,860. And for a family of four, it's $30,000. And this list continues as the family size increases and these amounts change each year. Let me show you how this works in an example. So let's say we've got Sarah, who's a single tax filer. She has $80,000 in undergraduate federal student loans, and her adjusted gross income is $40,000 for the year. Here's how her student loan payment would be calculated under the new SAVE plan. So her adjusted gross income, $40,000, and then we subtract out 225% of the individual household poverty rate, which for 2023 is $14,580. So you take $14,580, you multiply that by 225%, and that equals $32,805. So you subtract her AGI, or $40,000, minus $32,805, and that equals $7,195, which is considered her discretionary household income under the SAVE plan. Then you multiply that by 5%, and then you get $359.75, which is the amount of income she would have to commit towards her student loan payments for the year. Divide that by 12, and it comes out to roughly $30 per month. Under this new SAVE plan, some borrowers will not have to make any student loan payments. So if your AGI is below that federal poverty level that we just talked about based on your household size, there is no discretionary income left over to make any payments. So in that previous example, we used Sarah as a $40,000 income, but let's say Sarah only had $30,000 worth of AGI. So in that case, her $30,000 in AGI is below the roughly $32,000 federal poverty threshold for a one-person household. She would not be required to make any monthly student loan payments under the new SAVE plan. This income shield of 225% of the federal poverty level is a big enhancement for the SAVE program over the other income-driven repayment plans that are currently out there. Most of the current plans shield somewhere between 100 to 150% of that federal poverty level, which protects less income. And also by raising it to 225%, there are more borrowers that will not be required to make any payments under this new SAVE plan. Let's shift gears now over to the household size, because the household size obviously impacts how much you're going to have to repay per month under this new program. So when they say members in the household, what they're really referring to is dependents within your household. So if you look at Sarah, and let's say Sarah was a single filer and she had 2 roommates, she doesn't count those roommates towards the number of people in her household because they're not technically dependent. So on the SAVE application, it specifically asks the following questions. It says, how many children, including unborn children, are in your family and receive more than half of their support from you? And secondly, how many other people, excluding your spouse and children, live with you and receive more than half of their support from you? The website studentaid.gov has some absolute excellent resources to explain a lot of these changes that are happening. And one of the illustrations that they currently have on their website is a grid showing you some sample income and family sizes, so you get an estimate of how much you might have to pay each month. So this is what the illustration looks like. It's a grid, and basically you can find your AGI on the left, and then you can see your family size on the bottom. So in an example, if you had someone who was making $30,000 per year and they have 2 people in their household, they would not have to make any monthly payments under the SAVE plan, versus if you had someone who had an income of, let's say, $50,000, but they had 2 members in their household, they would have to pay an estimated $47 per month. Now, I'm going to highlight something odd here. When you look at the table, and if you think back to the example I gave you with Sarah. So for Sarah, she had $40,000 in AGI, and she was a one-person household. So when you look at this grid, it shows that her monthly payment would be $60 per month. But in my example, when I did the calculation, I said it would probably be around $30 per month, half that. Now, the only way I can explain what the difference might be is this SAVE plan is getting enacted over the course of almost 2 years. So there's some features of the plan that are going into place in 2023 and some features of the plan that are not going into place in 2024. And one of the items that is not getting phased in until July 2024 is the 5% of discretionary income payment amount. Right now, under the current repay plan, which it's replacing, it's 10% of the income. So for people that roll in the plan now, it's that 10% of discretionary income is the payment amount. But then when we get into July 2024, that's when those payments will reduce down to that 5% of discretionary income for a payment amount. On that note, I'll just disclose that I'm a certified financial planner. I don't work for the Department of Education, so we could be interpreting the calculation the wrong way, but as of today, that's what seems to make up the difference. Even though this 5% of disposable income for undergraduate loans, which is lower than the current 10% in the repay plan, doesn't go into effect until July 2024, there are certain aspects of the new SAVE plan that will go into place in 2023, and they include that larger income shield based on the 225% of the federal poverty level. Number two, the treatment of unpaid interest will change. We haven't covered this yet, but we will cover this later on, but it is an advantage within the SAVE plan of how they treat the interest. And the third is they're going to allow that married filing separately, or married couples who choose to file their taxes married filing separately will no longer be required to include their spouse's income in the monthly payment calculation under this new SAVE plan. So I keep saying undergraduate. Undergraduate loans and this 5% of discretionary income applied towards a loan balance. What about federal graduate loans? So while those are allowed to be entered into the SAVE program, they have different payment terms. So for any graduate loans, it's 10% of discretionary income is applied towards your student loan payments instead of 5%. And that's now and going forward. That then raises the question, what if you have both? What if you have both undergraduate loans and graduate loans? The undergraduate loans getting the 5%, the graduate loans getting the 10%. So what they're going to do is they're going to do an average weighted blend to reach some percentage in between those two, depending on what your ratio is from undergraduate to graduate. Okay, we've made it through all the payment stuff. Let's move on to how the forgiveness works within this new program. So within the SAVE program, the forgiveness period is somewhere between 10 to 25 years, and where you fall within that range will depend on what your original principal loan balance was within your student loan. So it's not what your balances are now, it's what was your original principal balance when you first took those loans out. Starting in July 2024, for any borrowers that had original student loan balances that were under $12,000, they can enter the SAVE program, make the income-based repayments required under the calculation, and then after 10 years, any remaining balance is completely forgiven. For every $1,000 that you have at original student loan balances over that $12,000 threshold, they add 1 year for your forgiveness timeline. For undergraduate, it's up to a maximum of a 20-year forgiveness. For graduate loans, it's up to 25 years of max forgiveness. So the way this would work was this. So if my original student loan balance was, let's say, $16,000, that's $4,000 over that $12,000 threshold. That means they add 4 years to that 10-year forgiveness cycle. That means after 14 years, if I have any balances remaining on those loans, that's when they would be forgiven. That then raises the question, do you get credit for years in the past that you've already made payments towards those student loans? And the answer is yes, you do. So here's an example. So let's say you started making payments on your student loans in 2018. So you made payments in 2018, 2019, and then COVID showed up in 2020. And due to the COVID relief, everyone had payment relief for 2020, 21, 22, and now 23 when the payments are restarting. So technically, you made payments for 18, 19. You get credit for the COVID relief for 20, 21, 22, 23. So essentially, you already have 6 years that count towards whatever your forgiveness timeline is under the SAVE plan. Now, while that sounds great, it says right on the SAVE application that forgiveness may be taxable, which means if you get forgiven $20,000, that could end up being a $20,000 taxable event to you and the year that loan is forgiven to you. Now, they have special rules right now that until 2025, the Biden administration put stuff in place. It said any student loans that are forgiven up to 2025, you don't pay tax on. But then after 2025, we could go back to the old rules, which makes those forgiven loans taxable. A question that might come up around the forgiveness timeline is what happens for borrowers that have multiple student loans that then consolidate the student loans into one. So they're going to rewind the clock. They're going to look at the start dates of when those loans originated, and then they're going to create an average weight of the start dates to then deliver you to your forgiveness timeline. Now we're going to talk about how interest works within these new SAVE plans because it's unique. So borrowers sometimes get nervous entering these income-based repayment plans that, hey, if I'm not making any payments or payments don't even cover the interest, isn't this loan going to keep ballooning on me because the interest is going to add and compound, and then if I fail forgiveness, I have this huge loan balance that I have to repay. So under the new SAVE program, they actually cancel unpaid interest as part of this loan payback plan. So the way that what that means is if let's say you do this income-based repayment calculation and they say you owe $50 per month, but let's say the interest on that loan for the month is $100, so it's not even enough to cover the interest. What they do is you pay your $50, and then the Department of Education cancels the unpaid interest for that additional $50, so it doesn't keep compounding into your loan. That additional interest is just wiped clean. When borrowers enroll in these income-driven repayment plans that have forgiveness, they have to be very careful about not missing payments, becoming delinquent, or defaulting on these loans because it can jeopardize the forgiveness aspect within these programs. So the Department of Education actually came out and said, we are going to give all student loan borrowers a fresh start. So if borrowers had late payments, defaults, delinquencies in the past before the COVID pause began, they can enroll in this new Fresh Start program and everyone is current. But you have to take action by September 2024 to actually enroll in this Fresh Start program to wipe away any delinquencies or defaults that might be in the past. And to do that, you have to either contact your loan servicer or contact the Department of Education's default resource group to say, I want to enroll in the Fresh Start program. The other positive to enrolling in this Fresh Start program is it removes all those late payments and delinquencies from your credit report. If you want to sign up for the SAVE plan for your student loans, how do you do it? So there's a few ways you can go about this. The most common will be you can go to the studentaid.gov website. You'll be able to apply for the SAVE program right in the website. You can get an estimate of what your monthly payment amounts will be, and you can ask any questions that you have about the SAVE program. You can also call 1-800-433-3243, and there's also a printable PDF of the SAVE application that you can download from the website. When you see the application for the SAVE plan, it's actually called the Income-Driven Repayment Plan Request, which includes most of the income-driven repayment plans that are available to borrowers. And you'll see a number of the different programs. So then the question arises, how do I know if the SAVE program is the right one for me and not some of these other programs that I see listed on the application? There's actually a box right on the application that says, I want the income-driven repayment plan with the lowest monthly payment, and you can check that box and they will evaluate based on all the programs that are available which one would result in the lowest monthly student loan payment to you. This SAVE plan is not going to be the right fit for everyone. While I spent a lot of time going over the features and the changes of this plan and the forgiveness and all that good stuff, you really have to individually evaluate for yourself whether enrolling in the SAVE plan is going to make sense whether you should stick to the 10-year standard 10-year repayment with those fixed payments over the life of your student loans, or if there's another income-driven repayment plan that would fit you better. In fact, it even states right on the SAFE plan application that your payments may exceed what you would have paid under the 10-year standard repayment plan, meaning if it's based on your income and household size, you could end up having to actually pay more than if you just went the old traditional standard route. Some of the major factors for borrowers are going to be their annual income amount, the size of their outstanding loan balance, the types of loans that they have, the size of their household, what their tax filing status is, how long they've already been paying on their student loans, and what you can afford to pay each month towards your student loan debt. It's also important to remember that the SAVE plan is an income-driven repayment plan, which means the payments will vary each year depending on what your income level is. So if you enter into this SAVE plan and you have $30,000 in AGI, which says you have to make no payments, but then let's say 2 years from now, you're now showing AGI of $80,000, that could dramatically increase your monthly payments on these loans. One of the headaches that they've seemed to fix with this SAVE plan is when you fill out that SAVE plan application, instead of having to go through the manual process of recertifying your income every single year, which was kind of a headache, now on that application, you can provide the Department of Education with authorization to access the IRS database so they can automatically pull your income every year from your tax filing and then update your payment, which makes it easier on borrowers. Now, what happens if you enroll in the SAVE plan and you realize you made a mistake? Oh, I should have never enrolled in this thing. It didn't work out the way I was supposed to. At any point, you can elect to transition out of the SAVE plan to any other type of repayment plan that you're eligible for. When you are trying to decide what program to enter for your student loan repayments, it can be very tempting just to run right to the program that offers you the lowest monthly payment, which in many cases may be this new SAVE plan, but you really have to evaluate the pros and cons over the long term. If you select that 10-year standard, so most student loans, you have a 10-year amortization, that payment is a fixed amount, which might seem higher at first, but as your income grows, that payment stays exactly the same, and then after the 10 years, you have paid back those loans in full. While the forgiveness aspect of the SAVE plan might also be appealing, you have to run the math and kind of say, well, if I make these payments in the SAVE program for 20, 25 years, how much would I have paid dollar-wise versus if I just would have selected a 10-year standard payback and then I know I'm done after 10 years. You have to also remember that the forgiveness could potentially be a taxable event. So if you get forgiven $100,000 10 years down the road, and that creates $100,000 worth of taxable income for you, you're in a 30% tax bracket, that's going to create a $30,000 tax liability that you have to pay in the year that that loan was forgiven. There are definitely some positive aspects associated with the SAVE plan. As I sit here in 2023, a lot of people haven't made student loan payments because of the COVID relief for the last 3 years, and inflation has gone up, so they don't have a lot of room in their monthly budget to now restart these student monthly loan payments. So this SAVE plan might allow them to start at a lower student payment amount to give them some breathing room, but instead of making those loan payments for 20 years, it might make sense to say, well, even though my minimum payment is $100, if I can make $300 or $400 per month and pay this thing off faster, then I'll do that. I hope this information was helpful. If you have any additional questions about the new SAVE program or other income-based repayment plans, I would strongly recommend you reach out to studentaid.gov. I'll put the link to the website, their phone number, and some helpful resource information in the description of this video below. Thank you.